On Business Incorporated today, Angola plans to accelerate debt payment on China loan. Nigeria liquefied natural gas declares force majeure. In South Africa, union strike persists, although a part of the union agrees on wage deal. Good afternoon. Welcome to Business Incorporated here on Channels Television. I'm Amy John McQuarrie. We'll begin, as usual, with market numbers. It's not very good for the NGX in Nigeria. That market has lost the 46,000 points and dropped to 45,000. And this is just at intraday. It's at 45,307. Wondering what will happen at the end of the day. It's persisting in that bearish sentiment. Yesterday, it was down 2.53%. Intraday today, it's down 2.28%. Very dangerous trends we see there in the markets in Nigeria. But it's opposite for the JSE in South Africa. As we see, the market is in the green, 0.33% at 66,411.56. We go to other parts of the continent, and what we see is Egypt is also in the red now, as bad as Nigeria, 0.25 at 10,122.96. Kenya closed yesterday also in the red zone, 0.09 marginal at 129.78. And from there we move over to the Middle East, where it's mostly green, or all green I should say, for the Middle East at intraday. Now let's look at the numbers there. Abu Dhabi 3.11% up. Very huge jump we see there, 10,045.19. Dubai also in the green, 0.76 at 3,402.70. Looking at other markets in that region, Saudi Arabia 1.68 in the green, 11,760.95. Qatar also in the green with 12,722.12. It's up 0.65 at intraday, doing really good there in the Middle East, unlike the mixture we have in Africa. Well, let's move over to Europe now and see what's going on there. One major conversation going on in Europe at this time is skyrocketing power prices, of course, following the war going on in Ukraine, going on between Russia and Ukraine. And the German government is rethinking energy policy. We've been discussing here on Channels Television on our different programs. We've talked about the energy crisis going on in Europe and some of the plans that they have to try to mitigate that. Well, the Chancellor, Olaf Scholz, has ordered all 3 of the country's remaining nuclear power plants to stay operational until mid-April next year. What are some of the implications? What are the reactions to this? We have Chris Colbert joining us now from Berlin. Hi, Chris. Good afternoon. What are the conversations going on with this? What's the major significance of this move?
It is significant on 2 levels. First, it aims to bridge the deep divisions that had been riven the Social Democrats' junior coalition partners on the issue in recent weeks. The environmentalist Greens, led by Economy and Energy Minister Robert Habeck, had argued that only 2 nuclear plants in southern Germany should be able to keep operating beyond the scheduled shutdown on December 31st to ease possible power shortages over the winter. Finance Minister Christian Lindner of the pro-business Free Democrats had suggested all 3, including the Emsland reactor in the northwest, should stay online even beyond April if necessary. And some Free Democrats had even called for 3 other nuclear power plants that were shut down last year to be powered up again in the face of high energy prices and possible blackouts. Now, Germany's 3-party coalition was unable to hammer out a deal on the use of nuclear power, despite top-level talks over the weekend. So the Chancellor putting down his foot marks for now a decision on a highly controversial subject within his government. Also, it is remarkable on a bigger scale as it recalibrates what has been Germany's energy policy for more than a decade, meaning to end the use of nuclear power in Europe's largest economy. It's a call then Chancellor Angela Merkel made in the wake of the Fukushima nuclear disaster in 2011, and successive German governments have committed to ending the country's use of nuclear power by the end of the year as part of its transition to safe renewable energy. But that time frame, well, that has now been changed.
Yeah, obviously changed. The necessities of the times are actually affecting it. But Chris, what does it mean for the stability of energy there?
Well, the three nuclear power plants have 4,300 megawatts of power capacity, contributing 6% to Germany's electricity production this year. Experts say these power plants are mainly needed to maintain grid stability at times of high demand, including from neighboring France, whose own nuclear reactors have faced a series of problems this year. Calls for an extended lifeline of the reactors had been particularly vocal in the south of Germany, as it has a strong industrial base, while at the same time, to this day, showing strong political opposition to the construction of wind turbines, for example. And there are still pitfalls. Extending the lifetime of these reactors needs to be enshrined into law, meaning the government needs to agree on the matter by tomorrow. German parliament, the Bundestag, needs to vote on it this week, and a majority there is not necessarily certain, mainly because of the Greens. Germany's Vice Chancellor and Economy Minister Habeck said that he could work with the Chancellor's decision and urged his party to go along with it. But there's large opposition and frustration among big parts of the Greens. They are pointing in part to the fact that this decision is not covered by a recent stress test of the nuclear reactors, and that conservatives and liberals just lost regional elections in the northwest of the country, lobbying for an extension of nuclear in Germany. So the Chancellor made a decision, but it's unlikely that it'll put this controversial subject to final rest.
Yeah, well, I guess we'll continue to follow that. How's the market doing?
The German Chancellor's decision to end the long quarrel within his government has given energy shares a boost, and overall investors also seem to regain their risk appetite. Germany's blue chips index DAX is advancing 1.1% this morning. However, this could be short-lived. The word from the floor is that markets are climbing a wall made of doubt and sorrow.
Chris, mixture there, and sometimes not so good, but thank you so much for the updates. Let's move over to the UK now, where Juliana is standing by in our studio there. Juliana, good afternoon. Well, we seem to be talking a whole lot about bonds, not just in the UK. We also had that conversation in Nigeria this morning, but now there are talks about delaying the bond sale. What's this about? And I think the Bank of England has been reacting to it.
Yeah, that's absolutely right, Illy. Bonds, our favourite subject, shall we say. But yeah, this is a really interesting story, actually. And in fact, that the Financial Times has got it wrong twice in just a matter of weeks. Last week, they tried to go with a scoop that perhaps the Bank of England would not end its bond buying, its long-term bond buying of government debt of 20 to 30 years. It came to an end on Friday. The Financial Times was saying that it was going to be expanded. The Bank of England didn't go on record to correct them, but of course it has since ended. And now again, the Financial Times this morning was saying that the quantitative tightening programme that the Bank of England once delayed on October the 6th would delay yet again. But the Bank of England have gone on record and said that is absolutely not the case, and that, yes, from Friday, this Friday, they are going to start the tightening program, you'll remember that in 2009, the Bank of England did start a mass program of quantitative easing. I believe at that time, during the financial crisis, they purchased about £175 billion worth of government debt. They did it again during the pandemic because, of course, interest rates were at a historic low and standard fiscal policy just wasn't enough to boost the economy. So they started printing lots of money. So they were supposed to start tightening that program at the beginning of the month. And then, of course, we had that huge fallout from the mini budget, which unearthed so many issues in the markets that they had to buy this long-term debt. So they did delay it. But they are going to be starting the tightening again. So the editors at the Financial Times very rarely have egg on their face, but twice in a row. And it just does go to show just how politically and economically unstable the British economy is at the moment. Because, of course, a lot of people, especially if you're a senior economic journalist, you do have sources within the Bank of England and the Treasury. But it seems as if they're all playing against each other at the moment. So just to repeat, the Bank of England have come out against the Financial Times report, which was picked up by Bloomberg, the Wall Street Journal and Reuters, to say that the quantitative tightening of that £865 billion is going to start on Friday.
Yeah, well, I hope politics is not playing into journalism now, Juliana, with all of this, you know, Financial Times and the Bank of England. But let's look at the markets. I think earlier, FTSE 100 was higher, and then we also saw that mortgage rates and, you know, everything seems to be meeting. What's the picture like at this time?
Well, yes, of course, we had the new Chancellor putting an axe to that mini budget yesterday, trying to calm the markets. And even though the markets have sort of been tempered, at least for the short term, it doesn't mean that the cost of living crisis is going anywhere fast. And we know that people on fixed and non-fixed mortgages are still struggling with high inflation, with high interest rates. In fact, since yesterday, I believe the interest rates of 5-year fixed-term mortgages has gone up from, I believe, 6.23% to about 6.35%. It is likely to get worse over the coming weeks, so your monthly mortgage rate is likely to be higher on top of all of the other bills that people are facing. We also just had a YouGov poll released about an hour ago showing that 90% of people who were surveyed want Liz Truss to go as Prime Minister. You know, it literally is just a matter of days that she has to cling on to power, which is going to be a massive headache for the Conservative Party because, of course, the British public don't want a third Prime Minister that doesn't have their own mandate. So we just have to wait and see what happens in number 10 Downing Street. She's due to be up against Sir Keir Starmer tomorrow at that dispatch box to get your popcorn, Innie. That is definitely going to be riveting viewing. But the FTSE All-Share at intraday is up by 0.83%. FTSE 100 up 2 by 0.89%, and the FTSE 250, the domestic market, doing pretty well with some strong company news. That's up by 0.61%. In the currencies market, which we've been looking at closely over the past couple of weeks, the British pound is currently trading down against the US dollar by 0.63%. So £1 will currently buy you just over $1.12. The British pound is also trading down against the euro by 0.44% and down to against the Japanese yen by 0.52%, Innie.
Yeah, mixed bag there, Juliana. Thank you so much. And that popcorn tomorrow, I'll watch out for it.
Yeah. Sweet and salty.
Yeah. All right, so let's move to Asia now. And shares in Asia Pacific traded high on Tuesday after Wall Street's rally overnight. In Australia, the S&P X 200 gained. Let's look at the numbers just behind me. Well, that starts with the Nikkei 225 in the green, almost 1.5%, 1.42 at 27,156.1 for the Shanghai. In the red, 0.13% down at 3,080.96, while the Hang Seng Index is positively up almost 2%, 1.82%. That's a big jump there, 16,000. 11,914.58, and all of that is at the close of trade today. The Shenzhen component was also in the green at 11,187, and there you see the Kospi there, and that's the Australia EX 200 at 1.72. More green markets than red, just like we had in the Middle East. In the United States, stock futures rose after the Nasdaq Composite posted its best daily performance since July. Nasdaq 100 futures climbed 1.8%. Futures tied to the Dow Jones Industrial Average gained, and S&P 500 jumped 1.5%. You can see the numbers just behind me. Well, the moves came after a winning day on Wall Street to start the week. The Dow Jones Industrial Average popped about 550 points, coming off a volatile past week of trading. The S&P 500 also rose 2.65% for the day. Nasdaq surged 3.43% as tech stocks rebounded, led by names such as Amazon, Meta Platforms, and Microsoft. It was the best day for the tech-heavy index since July 27. Solid earnings reports sent those stocks higher. This third quarter reporting season ramps up. Bank of America rose 6.06% after delivering better than expected results, and Bank of New York, Mellon, gained 5.08% after its own earnings beat. We'll take a break now. After that, we'll head to Africa, give you stories from there. You join us again. This is Business Incorporated on Channels Television. Welcome back. Still watching Business Incorporated on Channels Television, and we're talking about something that for some people, well, maybe not your favorite, because a lot of people are very health conscious in these days and times in Nigeria and the world. We're talking about beef. When last did you take beef? A lot of people have resorted to white meat, but let's see what's going on with beef. The price of a kilogram of beef has increased by more than 100%. In fact, analysts put it about 106% in 9 months, going from 1,700 per kilogram to 3,500 in the past 9 months. Well, let's find out what's going on with this. We do know that in Nigeria, there's that conflict between herdsmen and farmers. We do know the insecurity also challenging the movement of beef from the north, where mostly we have the cattle, to the southern part. But let's hear the perspective of Esther Majeure. She's an analyst with Financial Derivatives Company. Hi, Esther. Good afternoon.
Good afternoon. Thank you for having me.
Good to have you, Esther. I wonder if you're one of those who's been avoiding beef for health reasons, or you can take it.
No, not.
All right. So we do know. All right, we do know that the conflict between herdsmen and farmers is a challenge in Nigeria, and affected, for some time now, has been affecting the supply of beef. Is that what is responsible for this surge in prices, or are there other factors?
Yes, that is actually a dominant factor, but there are other factors actually, and one of it is the high cost of transportation. The vehicles that are used to transport or convey these cows, as you know, that beef is a byproduct from cattle rearing. And so the vehicles used in transporting, these cows, they use diesel. And because as a result of the increase in the price of diesel, that is actually coming in, increasing the price of the cost of transportation, actually. And so that's why that's another reason, because I think as 2021, November, if I'm not mistaken, to convey a head of cow cost about 800,000, in last year. And consider the fact that the cost of the price of diesel has now tripled, I'm sure it would have increased by now. So that is also a major factor. Another factor is the cost of feeding this, this cattle or this cow. It's the price of the feed has actually increased, because most of what is used to make this feed is actually from grain, and that is also affecting. And looking at the supply in the northern areas where this cows are reared, most of them have been attacked. Most of the northern areas have been attacked, and that has actually also limited the supply. And we must also know for the fact that the production in Nigeria, the cow we have in Nigeria is not enough for consumption for the whole population. And some are actually brought in from Chad, from Cameroon, and all of that. So we are also exposed to imported inflation as a result of that, because once the price of their own cow increases, it will also affect the price of cow here in Nigeria. So basically, that's what we are seeing also.
Yeah, so interestingly, what's going on with the alternative, the fish, the chicken? I know those prices are also surging, but is it because people are turning to them, or is also because of their own production costs?
Yes, more for the production cost, because most of these commodities are largely imported, and that would also as a result of the currency depreciation, it also affect the cost. And rearing them in Nigeria also, because of the high cost of doing business in Nigeria, it has also discouraged many industry in that aspect. Most of them have had to close their shops because they cannot cater for the feed for the animals, and all of that, are actually affecting the price of the cost of this product actually generally.
All right, Esther Majeure, thank you so much for sharing your perspective with us this afternoon. Okay, moving on now. Nigeria Liquefied Natural Gas Limited has declared a force majeure on shipments from its Bonny Island liquefied natural gas facility after supplies were cut off by flooding. The notice by the gas supplier was as a result of high flood water levels in their operational areas, leading to a shutting of gas production, which has caused significant disruption of gas supply to NLNG. NLNG, which produced 22 million tons of liquefied natural gas a year, was already operating at a reduced capacity because of difficulties securing adequate feedstock. The company is a joint venture between the state-owned Nigeria National Petroleum Company and Shell PLC, Total Energies SE, and ENI SPA. The shareholders are also the plant's main providers of gas. NLNG is reviewing the situation with gas suppliers to ascertain the extent of a disruption to its operations. Angola is taking advantage of higher oil prices to accelerate its debt reduction plans and smooth out repayments to China, which is its largest creditor. Africa's second largest crude producer owes China $18 billion, which is about 40% of its total external debt, after settling loans totaling $1.32 billion this year. Angola's debts as a proportion of the gross domestic product is projected to fall to about 61% next year. That's down from 66%, which at this point in time, and more than 100% was the position in 2020. Well, this attributed improvement in the metric to a rebound in economy, the nation's currency, and the government's conservative approach towards taking on new loans and determination to reduce interest costs. And from there, we head to South Africa. We've been talking a lot about strikes going on there. Now, the state-owned ports and rail operator reached a 3-year wage deal with its biggest labor union, with its members agreeing to immediately call off a strike that caused a slowdown of exports of minerals and other goods. Transnet SOC Limited has offered to pay workers raises as much as 6% and improve housing and medical benefits. And this was accepted by United Transport Union, which represents about 54% of the workers. However, it's not all of the groups that have agreed, because smaller Transnet Union has vowed to continue port strike in spite of this wage agreement. And that's it on the program today, the second one for the week. We do have more for this week. Do join us tomorrow, 1:30 for Business Incorporated. For 10 a.m. first, Laddie Williams will be here to give you relevant and current conversations on Business Morning. I'm Ini John Mekwa. Enjoy the rest of your day.